At the intersection of Wall Street and Broad Street, the machinery of global capital does not pause for political rhetoric. It operates on a frequency of risk and return, a binary code of profit and loss. But at 9:30 hours this morning, that frequency was jammed. A signal originating from the executive branch did not just interrupt the market. It rewrote the physics of lending. The proposal to cap credit card interest rates at 10% is not a policy suggestion. It is a kinetic weapon aimed at the foundation of the banking sector. And the tremors being felt in the glass towers of Manhattan are not fear. They are the vibrations of a structural collapse. The modern economy runs on the precise pricing of risk. Unsecured consumer debt, the plastic in the wallets of millions, carries a premium because it carries a probability of default. The current market equilibrium has set that price above 20%. This is not arbitrary. It is the mathematical output of actuaries and algorithms calculating the likelihood of repayment. When the executive branch attempts to forcibly compress that number to 10%, it does not lower costs. It destroys the equation, and when the equation is destroyed, the flow of capital stops. This is what is happening behind the closed doors of the nation's largest financial institutions. The captains of capital are not drafting press releases, they are running simulations. And every simulation ends in the same result: a credit freeze. If the government mandates a price for money that is lower than the cost of the risk attached to it, the banks will not lend. They will simply exit the arena. The result will not be cheaper loans for the working class. It will be the evaporation of credit for the very demographic the policy purports to help. In the high-ceilinged conference rooms of Midtown, the mood is clinical. The men who manage trillions in assets understand that they are being set up. They see the trap. The proposal is a win-win for the populist engine in Washington and a lose-lose for the financial architects in New York. If the banks comply, their profit margins on consumer lending are obliterated, and their stock prices already bleeding 5% in early trading will hemorrhage. If they resist, if they tighten lending standards to protect their balance sheets, they walk directly into the narrative constructed for them. They become the villains. They become the greedy elites, denying capital to the struggling common man. The architect of the nation's largest bank, a figure who usually speaks in the guarded language of basis points and guidance, dropped the veil of diplomacy during the earnings call. He did not appeal to emotion. He pointed to the mechanics of the engine. The system cannot support this load, implies the statement. It is a declaration that the infrastructure of credit is not elastic. It has a breaking point. And the executive is currently standing on the gas pedal, driving the economy toward that edge. This confrontation reveals a deeper fracture in the governing coalition. For years, the alliance between deregulation-hungry financiers and cultural populists held together. It was a marriage of convenience. Wall Street tolerated the rhetoric in exchange for tax cuts. But the bill has come due. The populism that was once a useful tool for gathering votes has mutated into a policy agenda that threatens the viability of the business model itself. The executive is no longer interested in the invisible hand of the market. He is interested in the visible fist of the state. Watch the tickers. The red numbers flashing across the screens are not just stock prices falling. They are a vote of no confidence. The market is efficient. It digests information and spits out a price. And right now, it is pricing in a regime change. Not a change of administration, but a change in the rules of the game. The assumption that the United States operates as a free market economy, where prices are discovered rather than dictated, is being revised downward. In the algorithmic trading centers of New Jersey, the servers are reacting faster than human traders. They are dumping exposure to the financial sector. This is not panic selling. It is a programmed response to a new variable: political risk. For decades, political risk was something investors factored in when deploying capital to emerging markets, to unstable regimes on the periphery of the global order. Today, that risk premium is being applied to the United States. The sovereign risk of American policy has just spiked. Consider the mechanism of the credit card. It is the lubricant of the consumer economy. It bridges the gap between paychecks. It smooths out consumption. When that lubricant is removed, the engine seizes. The warning from the bank chiefs about a significant economic slowdown is not a threat, it is a forecast. If 40% of the population suddenly loses access to credit because they are deemed unprofitable under the new 10% cap, consumption collapses. Retail sales flatline. Inventory piles up. Factories slow down. The recession that follows is not a natural cycle, it is a manufactured disaster. But the executive operates on a different timeline. The economic consequences, the recession, the credit crunch are future problems. The political benefit is immediate. The narrative of fighting the usurers and money changers is potent. It resonates. It bypasses the logic of economics and taps directly into the vein of grievance. By picking a fight with the most unpopular industry in America, the executive inoculates himself against the coming economic pain. When the slowdown hits, he will not blame his policies. He will blame the banks for sabotaging the recovery. He is pre-positioning the scapegoat. The credit-restricted warning from the head of the second-largest bank is a polite way of saying class warfare, because that is who gets cut off first. The prime borrowers, the wealthy with perfect credit scores, they will keep their cards. They are low risk. The 10% cap might still be profitable for them. But the subprime borrower? The worker with a thin credit file? They are erased from the ledger. The computer simply says no. The irony is sharp and metallic. A policy sold as a shield for the poor acts as a gate that locks them out of the financial system entirely. Inside the regulatory agencies, the civil servants are paralyzed. They are receiving orders to draft rules that contradict the foundational statutes of banking safety and soundness. They are being asked to enforce a price control that guarantees insolvency for smaller lenders. The community banks, the credit unions, they do not have the diversified revenue streams of the Wall Street giants. They live on the spread between what they pay for deposits and what they charge for loans. A 10% cap does not just hurt their profits, it threatens their existence. The executive is inadvertently or perhaps deliberately driving a wave of consolidation that will leave only the largest, too big to fail institutions standing, and then he will target them. The mutiny on Wall Street is quiet. It does not look like a protest. It looks like a capital strike. You will see it in the tightening of limits. You will see it in the rejection letters. You will see it in the sudden disappearance of 0% introductory offers. The perks, the points, the cash back, those are the trimmings of a profitable system. When the profit is outlawed, the trimmings vanish. The austerity that is coming will be strictly enforced by the balance sheet. This is the collision of two absolute forces. On one side, the political imperative to deliver a tangible victory to a base squeezed by inflation. On the other, the mathematical imperative of a financial system that requires yield to survive. There is no middle ground. You cannot negotiate with arithmetic. If the cost of funds is 5% and the cost of default is 6%, you cannot lend at 10%. You lose money on every unit. And banks are not charities. They are profit-seeking organisms. When the environment becomes toxic to profit, the organism hibernates. The silence from the Federal Reserve is deafening. The central bank is the guardian of financial stability. Usually, a proposal that threatens the solvency of the banking system would elicit a sharp rebuke from the chair. But the chair is silent. Perhaps he understands that the independence of the Fed is also on the menu. If the executive can dictate interest rates on credit cards, why stop there? Why not dictate the federal funds rate? Why not order the printers to run faster? The 10% cap is a probe. It tests the defenses of the technocracy. If it pierces the armor, the next strike will go deeper. In the law offices of Washington, D.C., the constitutional challenges are already being drafted. The argument is that the executive lacks the statutory authority to impose price controls on private contracts. They will cite the Takings Clause. They will cite the Administrative Procedure Act. They will build a fortress of paper to stop the order. But the law takes time. Markets move instantly. The mere threat of the policy is already reshaping the landscape. Capital is cowardly. It flees before the first shot is fired. And right now, capital is fleeing the consumer lending sector. The volatility index, the fear gauge of the market, is ticking upward. It is sensing the instability of the architecture. A system built on trust and contract law is being subjected to the unpredictable stress of executive fiat. The investors who buy the bundles of credit card debt, the pension funds, the insurance companies are stepping back. They are asking, what is this asset worth if the government can change the yield at will? When the buyers disappear, the securitization machine stops. And when that machine stops, the liquidity drains out of the economy like oil from a ruptured sump. We are witnessing a stress test of the American capitalist model. Can it function when the pricing mechanism is hijacked by political necessity? The answer coming from the trading floors is a resounding no. The distortion is too great. The signal is too jammed. The disconnect between the political reality and the economic reality is widening into a chasm. And into that chasm, the prosperity of the consumer is falling. The mutiny of Wall Street is not an act of rebellion. It is an act of preservation. The banks are sealing the bulkheads. They are preparing for impact. They know that the 10% cap is not an economic policy. It is a declaration of hostilities. The executive has identified a target that is rich, unpopular, and vital. He is shelling it. The collateral damage will be the credit access of the very people cheering the bombardment. But in the heat of the moment, the noise of the shelling drowns out the sound of the structure cracking. And make no mistake, the structure is cracking. The delicate web of trust that allows a stranger to swipe a piece of plastic and walk out of a store with goods is fraying. That transaction relies on a promise to pay, and a belief that the payment is worth the wait. The executive is altering the terms of that promise. He is telling the lender, you will take less. He is telling the borrower, you owe less. It sounds like a jubilee. It acts like a default. The analysts in the risk departments are recoding the algorithms. They are adding a new variable, executive intervention probability. This variable degrades the value of every loan. It forces the bank to hold more capital, to be more conservative, to take fewer risks. The animal spirits of the economy are being caged, not by regulation, but by uncertainty. The most dangerous state for a market is not a crash, it is a fog. In a crash, you know the price. In a fog, you know nothing. The fog is rolling in from the Potomac. It is settling over the canyons of the financial district. And in that fog, the shapes of the future are distorted. Is this the beginning of a command economy? Is this a temporary negotiation tactic? The uncertainty is the toxin, and the antidote clarity is in short supply. The executive thrives on ambiguity. The market dies on it. This is the state of play as the sun sets on the trading day. The bells ring, closing the session, but the problem remains open. The positions have not been squared. The ledger is unbalanced. And the men who run the system are going home to sleepless nights, knowing that when the bell rings tomorrow, the assault will continue. The machinery of finance is robust, but it is not indestructible. It can be broken. And there is a man in the White House who seems intent on testing exactly how much pressure it takes to snap the spine of the system. The machinery of rejection operates in silence. It does not require human intervention. In the data centers of Northern Virginia, where the credit scores of 300 million Americans are stored, the parameters have already been adjusted. The algorithm does not discriminate based on malice. It discriminates based on the new variable introduced by the executive, the 10% cap, and the output is a cascade of denials. The man in Ohio, the woman in Arizona, the contractor in Pennsylvania, they do not know that they have been redlined. They swipe their cards at a gas pump or a grocery store, and the terminal displays a generic error message. Declined. This is not a glitch. It is the sound of the financial system contracting. It is the sound of risk capital retreating to higher ground. The banks are not formally announcing a boycott. They are simply updating their risk models. And the new model says that lending to anyone with a credit score below 720 is a mathematical impossibility at the mandated rate. This is the credit freeze predicted by the CEO of the nation's largest bank. It is not a sudden stop. It is a slow asphyxiation. The credit limits are lowered. The accounts are closed for inactivity. The lines are drawn tighter. The economy, which relies on the velocity of money, begins to decelerate. When liquidity is withdrawn, friction increases, and friction generates heat. Inside the West Wing, this friction is not viewed as a failure, it is viewed as fuel. The political strategists surrounding the president understand the utility of a villain. The banks are the perfect foil. They are distant, abstract, and wealthy. When the economy slows, when the loans dry up, the executive will not accept responsibility for the distortion he created. He will point to the towers in Manhattan and accuse them of sabotage. He will claim that the deep state has extended its tentacles into the financial sector to punish his voters. The narrative is already being constructed. The greedy bankers are refusing to help the working man. They are hoarding capital. This is the language of populism, and it is a powerful solvent. It dissolves the complex reality of risk pricing and replaces it with a simple, moral play. The executive is the protector. The banks are the predators. The fact that the executive's policy is the direct cause of the credit contraction is a detail that will be buried under an avalanche of grievance. But the bankers are not passive actors. In the boardrooms of Charlotte and New York, a counter-strategy is forming. If consumer lending becomes unprofitable, they will pivot. They will shift capital to sovereign debt, to corporate bonds, to assets that are immune to populist price controls. They will strip the retail divisions to the bone. Branch closures will accelerate. Automation will replace tellers. The human touch of banking will be liquidated to preserve the dividend. The result is a banking system that serves the state and the corporation, but abandons the citizen. This creates a vacuum, and nature abhors a vacuum. Into this void steps the shadow banking sector, the payday lenders, the pawn shops, the unregulated fintech apps. They operate outside the perimeter of the 10% cap because they operate outside the traditional definition of a bank. The irony is structural. A policy designed to save the poor from high interest rates drives them into the arms of lenders who charge triple digits. The protection is a mirage. The reality is a black market for credit. The Federal Reserve finds itself in a tactical bind. Its mandate is full employment and stable prices, but it has no tools to combat a credit strike driven by regulatory fiat. If the Fed lowers rates to stimulate lending, it feeds inflation. If it raises rates to fight inflation, it crushes the banks further. The central bank is checkmated. The levers of monetary policy have been disconnected from the engine. The chair sits in his office, watching the monitors, knowing that the transmission mechanism of policy has been severed by the executive's intervention. And then there is the legal war. The best constitutional lawyers in the country are currently drafting briefs that challenge the authority of the president to rewrite private contracts. They cite the Due Process Clause. They cite the separation of powers. They argue that the power to regulate commerce does not include the power to destroy it. But the courts move at the speed of the 19th century, while the markets move at the speed of fiber optics. By the time a judge issues an injunction, the damage to the credit infrastructure will be calcified. The capital will have fled. The accounts will have been closed. The executive knows this. The delay is part of the weapon. He does not need to win in court. He needs to create enough uncertainty to force a capitulation. He is betting that the banks, terrified of antitrust investigations and regulatory harassment, will come to the table. He wants a deal. He wants them to voluntarily lower rates in exchange for some other concession, perhaps a relaxation of capital requirements or a blind eye turned to mergers. It is transactional governance. The law is not a fixed boundary. It is a bargaining chip. But there is a darker possibility lurking in the data. If the private banks retreat, if they refuse to lend, the call for a public option will grow louder. A state-owned bank, a Patriot card issued directly by the Treasury. It sounds efficient. It sounds benevolent, but it is the ultimate consolidation of power. If the state controls the credit, the state controls the citizen. It can decide who buys a house, who starts a business, who travels. The financial system ceases to be a market and becomes a mechanism of social control. The mutiny on Wall Street is essentially a refusal to participate in this transformation. The CEOs are not just protecting their bonuses, they are defending the autonomy of capital allocation. They understand that once the allocation of capital becomes a political function, the economy becomes a patronage network. Efficiency dies, innovation rots. The United States begins to resemble the stagnant, state-dominated economies it spent the 20th century defeating. The indicators on the screens do not lie. The spread between corporate junk bonds and treasuries is widening. This is the market pricing in the risk of a systemic error. The investors are demanding a higher premium to hold American corporate debt because they no longer trust the rules of the game. They see a government that is willing to sacrifice the long-term stability of the financial architecture for a short-term political sugar high. In the hallways of the Capitol, the Republican orthodoxy is fracturing. The old guard, the defenders of free markets, are silent. They are afraid. They have seen what happens to those who oppose the ruthless architect. They saw the fate of the senators who tried to block the Venezuela operation. They know that to defend the banks is to commit political suicide. So they look at their shoes, they mumble about concern, and they let the machinery of the market be dismantled, bolt by bolt. The collision is imminent. The banks cannot lend at a loss. The executive will not retreat. The immovable object meets the unstoppable force, and in the middle, the consumer economy is being compressed. The holiday shopping season projections are being revised downward. The auto loan market is stalling. The housing market, already fragile, is bracing for a freeze. The significant economic slowdown is not a probability, it is an arrival. This is the architecture of the new era. It is an era where the price of money is determined not by supply and demand, but by the will of the leader. It is an era where the private sector exists only at the pleasure of the public sector. The mutiny of Wall Street will be crushed, or it will be co-opted. Either way, the era of independent finance is ending. The invisible hand has been broken. What remains is the visible hand. The hand that signs the executive orders, the hand that directs the anger of the crowd, the hand that turns the valve of credit on and off. The system has been rebooted. The operating system has been changed, and the new user agreement is non-negotiable. When the machinery of credit stops, it is not a malfunction, it is a design feature.